Visa stock is 7% off all-time highs. We've been provided this great sale for one of the most reliable companies in the entire world. So today, I'm going through the business model of Visa and then answering the question of, is Visa stock currently undervalued? I want to start the main part of this video by talking about the strategy of why you would pick a Visa to add into your portfolios. What's the thesis behind holding a company like Visa? To help explain this, I've just made a scale here, or a spectrum, of the different types of companies you can hold in terms of their reliability. Sometimes you want some speculative plays in your portfolio that can go up a lot in value. Other times you just want a nice reliable company that's going to go up there 15% every single year, almost no matter what. On the less reliable end of the spectrum, you've got companies that make less than 1 billion in revenue. Small cap companies, or those with extremely volatile businesses where they double their profit one year and then lose money the next. Highly speculative and can often go out of business. In the middle, I actually have big tech companies and many other large S&P 500 names. If you're a company that is going to go down 80%, 70% on risk of recession, then you do not want to have 100% of your portfolio in those companies, because that's what we saw in 2022. If you held a name like Facebook or Nvidia in 2021, then you lost 80% of your money by the halfway point of 2022. It's great to buy those companies, especially at low prices and valuations, but we are just not sitting in those times right now. And that leads me to talking about Visa. Now, the reason why I'm looking for companies like Visa right now is we're seeing valuations of the stock market hitting all-time highs. We are at risk of a 20% pullback in the S&P 500. Those great companies experience very strong sell-offs because they're economically sensitive. Visa is too, but it tends to only sell off 10 or 20% instead of 40. And with that strategy talk out of the way, let's start getting in depth with Visa and their business model. Visa makes its money through transaction fees. Every time you use their debit card, credit cards, about 0.5% of the total amount of money spent goes straight to Visa. Visa, for example, does not need to build out a utility network. It does not need to build factories or even data centers. Most of Visa's upkeep is in terms of workers, but also just their brand and their reputation. And therefore, it's no surprise that about 50% of all revenue goes straight to the bottom line, goes towards net profit. And whenever you have that much profit margin, a huge extent of your profit goes to things like share buybacks and dividends. However, when you have a mature company that's been around for a long time, like Visa, they've almost always maxed out their profit margins. We're not going to see much more earnings per share growth coming from higher profit margins. Future earnings per share growth is going to have to come from two places. They are going to come from revenue growth and share buybacks, which is why straight away we're going to have a look at cash flow going towards shareholders. So pretty much that just means dividends and share buybacks. And we see here that operating cash flow is about 6.3 billion, and that's per quarter as of a couple days ago. Now, really quickly, we're just going to see here less capital expenditures was only $421 million. It's that extremely efficient business model which allows Visa to keep reinvesting in itself in things like their share buybacks, which, having looked below, they're currently spending about $4.8 billion per quarter, which is, if you annualize that number, about 2.8% of all shares getting bought back per year, and about 1.1, or about, 0.5% as a dividend rate on top of that as well. And once again, because Visa doesn't have things like data centers that need to be built or huge expenditures just in general, that share buyback is just always going to be maintained. And people actually add extra valuation to the company just because Visa is just never going to have a business drought. Everyone still needs to buy their groceries and essential spending on their debit and credit cards. When we have a look at Visa's PE ratio, this one gives us a nice long-term look, but it is a trailing PE ratio, which I don't really like. Visa is sitting at a 40, roughly 38 trailing PE ratio, which is quite expensive. But when we remember that Visa's revenue and profit is extremely consistent. You can see that in the earnings per share of the chart going consistently up almost every single year, as well as the stock price. So therefore, Visa deserves that extra valuation, even more so than things like, the big tech companies. I've gone above and beyond for you guys because I've made a forward P ratio chart on Visa's stock price chart, just showing us, through forward P ratios, what are some, patterns we're seeing in the valuation of Visa? When does it tend to bottom out in stock price, and when does it hit a bit of a maximum? At the moment, we are sitting on a 26.4 P ratio for Visa, which is not the best price to pay, but it's certainly not the worst. We tend to see, as you can see at the top there, when we hit a 30 or a 29 forward P ratio, maybe even a 28, that's roughly when we see Visa start to struggle to go higher and higher in price. But we tend to see, in terms of the bottoming of Visa, around a 26 for the last year, or even down to as low as a 23.5. That's usually the time when, we're getting signals to load the boat on Visa stock. And when we take into account the earnings per share, which is shown in the top left there, growing around 13% per year, typically for that type of growth and the quality of a company like Visa, I would like to be buying it below about a 24 down to about even a 20 forward P. But Visa is such a highly reliable, high quality company. So my thoughts about Visa right now is that I'm just going to buy some shares today because, we've got a good price here, not the best. Guarantee that price right now. I can always increase my shares in Visa if we get a sell-off. And to be honest, even if the stock sells off 20% from today, I'll be really welcoming that sell-off because I'll be able to guarantee better investment performance in the future. But if we have a look through the financial details of Visa for the last quarter results, which came out a few days ago, we can really start to hone in if analysts are correct. We should always double check. So I'm going to go through the revenue sources of Visa here, and pretty much all the categories are just about transaction fees, which if we average all of those out, we get around a 13-14% revenue growth. However, we see here a category called other revenue, which are things like data analytics. They sell your spending data onto other people perhaps, and also things like cybersecurity. Now, these companies might not mention they're selling your data, but pretty much they all are. All of that averages out to 14% revenue growth for the last quarter. But again, if we continue seeing really strong performance in that other revenue, and even the basic transaction fee revenue could grow stronger in the future if we continue to see a strong economy, kind of like we've been seeing in the last 6 months. We are looking at the total number of debit and credit cards that are issued over the last year, growing around 7% on average. Now, the reason I like this is it's telling us really the number of true customers that are going up each year. Now, not every single customer has cards. Their data analytics business doesn't have cards associated with that, but this gives us a rough metric of how the everyday business is doing. Roughly half of the revenue growth of Visa is just coming from more customers, which is great. And then about 7% is increases in the spending of customers, but also the price that Visa is charging on those transactions likely goes up a couple percent each year. And to get the picture of what the profit is going to do, we need to see how the costs or the expenses of the company are growing. Now, this is where we start to see a reason why Visa could be struggling over the past few quarters. So the main business has expenses growing around 13-14% on average. Again, because the revenue and costs are growing by the same percent, that just means profit margins are not getting much better over time, maybe a little bit better. But we have a gigantic expense called litigation provision, which is around 20% of the total expenses. That is a once-off cost or a very short-term cost that's been going for a few years. Now, the litigation cost, which is throwing off the entire profit margin of Visa, that's associated with fighting off monopolistic fines and investigations from people like the US Department of Justice, and I'm sure the Europeans and other regions are also taking their little slice. They love giving out big fees to American companies. Visa and MasterCard settled a class action about their duopoly type relationship with the market for $5.6 billion in 2019, but there could be ongoing legal fees with fighting off more investigations. I believe one was reinitiated last year, so that $615 million is probably just putting money aside to fight these legal battles that every big company today is facing. And this is where I'm going to have a look at the income statement summary. That just really looks at revenue and then final net income, profit. About half of investors could be relying on the GAAP earnings, or in other words, they just take into account all expenses no matter what. We're growing earnings per share 12%. That's the standard number that people quote. However, sometimes I like to look at the non-GAAP earnings per share. Non-GAAP really just means short-term cost or revenue are eliminated. And when we do that, the company is growing profits 23% compared to last year. That 23% growth rate gives Visa a much more attractive growth and therefore valuation story. So if we ignore these short-term, mainly legal costs, then Visa is actually considered quite cheap at the moment. Going back to that forward P ratio chart of Visa, now this was constructed with the non-GAAP numbers because those are the ones that I like. But in my mind, what I'm thinking is half of investors prefer the GAAP earnings. So when we have these legal fees slowly get eliminated over time, maybe that could be as soon as next quarter, maybe that could be a year away, nobody really knows, but that would make the GAAP earnings almost the same as non-GAAP. Or in other words, that gives half of the investor base an excuse to buy back into Visa stock. So we have a good catalyst over the next couple years. Altogether, that's looking like a picture of about 15 to 16 earnings per share growth for Visa for the future. And that starts to bring down valuations by roughly 5%. That makes the valuation story on Visa more appropriate, something like a forward P of about 25, smack bang in the middle of its valuation story. So therefore, I've added Visa stock to my growth on sale portfolio. Honestly, I probably won't add too much extra Visa in until it goes through a bit of a sell-off. Great place to initiate and kind of see how Visa stock goes. This also leads to a commentary about the stock market and a bit of strategy I'm employing right now, which is actually buying some SPY put options. In other words, I'm making a leverage bet with only a small part of my portfolio. I know on this growth on sale, it's about 15% of the portfolio, didn't have much choice, but ideally I've got around 2-4% of my portfolio sitting in SPY put options, just in case we have a sell-off in the market, that I'm protected. I'm expecting a bit of downside over the next couple months just because the stock market has been so overbought in the short term. So I would say subscribe to the channel here if you want to see the portfolio beat Wall Street, beat the S&P 500, or maybe I just fail, lose a bit of money here, and you guys can just call me an idiot on the channel. That's great too. It's always good to have a laugh.